Your life.
Hello, everyone, and welcome to our anniversary event, Metamorphosis. I think it's a very accurate name for the kind of situation we are in today as well, where we're taking very intractable policy problems and converting them into very innovative solutions. So I welcome all of you to this event. Thanks for waiting as we got set up. And it's been a year of Policy 4.0. So just to give a few remarks as it is our anniversary. Hi, everyone. I am Tanvi Ratna. I'm the founder and CEO of Policy 4.0. Policy 4.0 is a fairly unique policy advisory body, policy research body that was set up exactly 1 year ago, launched exactly 1 year ago on November 18th, 2020. And this is when we launched with our 4-part report series on the Chinese digital yuan. And we had taken a fairly unique approach to policy research, and that is part of our USP in general, is that we are taking very innovative approaches into how we design policy solutions. We combine engineering, legal, economics, finance, and all these disciplines together in the analysis we do, because as we all know, we're living in a very changed world, and not a lot of what we did before can help us as we go forward. And it is with that as a premise that we also set up Policy 4.0. So Policy 4.0, its mission is to build a harmonious digital future. And what do we mean by that? As we see around the world, there are a lot of rising frictions between technology, society, and the state. And these have become very large policy problems that most of our traditional approaches are really failing to solve. And there is not much we can look to in our past to solve these problems. So it is time now to really innovate in areas of policy, so we can address these challenges and we can manage policy goals and outcomes for people in our countries. And India being a very tech savvy state, India being one of the youngest states in the world, being the largest democracy in the world, it's an honor for us to be housed here in India. As it is just very fitting with our mission of building a digitally savvy and forward-thinking policy framework. So just in terms of our mission, in terms of our vision, I'll be very happy to take you through some of our milestones as well over the last year. And I think I would just request right now that we share a video. It has been an interesting journey for us as we've navigated a fairly innovative topic, which is the future of money, where we started our work with CBDCs and cryptocurrency, and we have done a variety of things in that domain. So I think these will be better conveyed via a video. So I'll ask my team to just share that. And Great, thanks for that. So that was just something small put together by a team in Formby. But it's been an amazing year. I think cryptocurrency has grown substantially. So of CBDCs, we started with looking at CBDCs in a post-COVID world. That's when we started our deep dive into China's digital currency. And since then, as you see, it's been a global journey. We've convened multiple dialogues of global regulators and stakeholders looking into CBDC and cryptocurrency topics. And now we are at a momentous moment in India where the legislation in India is getting drafted. I think you're hearing about it from many directions. We've been speaking about it all of last week to many leading media houses and journalists. I've personally been just in the last 4 days on debates with Mr. Arnab Goswami, with Mr. Rahul Kaval, with Ms. Barkadat. And so cryptocurrency, digital currency has really gone mainstream as a policy topic. And in this debate, there are just many angles that are very unexplored. There are many questions more than answers. And in our mission as the kind of policy body that we envisage to be, it is our endeavor to build answers, to not add to the noise, but to build solutions that actually work for policymakers. And we've been hard at work building those for India, because as I've been saying repeatedly, there's very little by way of precedent in terms of tackling these monetary risks. And I will be taking you through some of these pointers when we unveil our solution. But before we even go to the level of our solution, it's very important to frame the policy debate. And I think sometimes the success of finding right answers comes from asking the right questions and having the right premise. And that's why we believe a policy framework to the way we are thinking about cryptocurrency, a policy framework, something that looks very comprehensively at what are all the issues around cryptocurrency that any effective legislation must address. That becomes very important. And I'm very honored to host our advisory board in tackling this question. We will be also releasing this as part of the report that we launch. But the first discussion that we'll kick off with today is on really understanding the policy risks that India needs to tackle when looking at its cryptocurrency policy. So we'll just invite on board our board members, and we'll get started with this panel in just a minute or two. And in the meantime, if you have any questions or you have any comments, feel free to leave messages in the live chat. Feel free to raise questions there as well. You can also comment on the video. So our team will be tracking that and sharing questions with us, and we will raise those to the panelists. So let's go ahead and invite our board members. And I think our board members, we have introduced them in our video as well. And I think we are very honored to have the guidance of such esteemed policy experts in our board. So without much ado, I'd like to introduce all of them. We have also on the call with us today, Dr. Ashima Goyal. Dr. Ashima Goyal, she is one of the foremost economists of India, and she's a part of the Monetary Policy Committee of the RBI. She's been one of the foremost monetary economists of the country. So it's an honor to have her on our board. We have Mr. Pramitpal Chaudhary. He has been a two-time member of the National Security Advisory Board. He's one of the leading strategic affairs thinkers of India, and I think this is an angle that is very important to highlight when we think about cryptocurrencies. We also have Dr. Douglas Arner, who is a leading international financial regulations expert. He is someone who works closely with many regulators across the world, including with international bodies such as the FSP or the FATF, the BIS. And I think a big part of India's approach will be in tackling harmonization of laws as well. Last but not least, it's an honor to have Mr. Cherian, who is, I think, far better known than maybe most of us. He is one of the leading experts when it comes to the whole art of setting narratives and frameworks and all policy debates that occur in India. And I think that is that's a skill that becomes very important when we think about debates around emerging technology. It's an honor to have all of you in the event. Welcome everyone to our anniversary event.
Thank you. Great to be here.
Thank you.
So to start,
congratulations.
Yeah, thank you. So we are live streaming now. I think we have quite a variety of audience from there are crypto enthusiasts, there are policymakers, there are journalists, there are fintech enthusiasts, there are people from banks and financial institutions. So we have a whole variety of stakeholders watching this. I think to start off with, just in terms of the framing of this debate, I think I'll start my first question to you, Mr. Cherian, and the whole debate around cryptocurrency. What do you think anything's missing?
I think certainly lots of things are missing, but I'm going to highlight just two to start with. I think what is that the consciousness or the awareness that crypto evolved and has now become seen as a kind of harbinger of those who are not happy to be confined by the nanny state. So that's something that we need to take into account. There is, of course, the fear that people may misuse it, the deep, dark threat of terrorism and all of that. But what is missed out in much of the debate is that the evolution of crypto and its narrative today, and you spoke about narratives, is about people who want to, in some senses, steer clear of the nanny state. And the second thing, I think, is the lack of recognition that the entire crypto space could be a place where all kinds of new entrepreneurship could be incubated and flourish. And the particular opportunity that happens to be available to India is being able to use this technology in the kind of economy that India is. And I think this is very crucial. People don't recognize that India has a very, very special opportunity because the nature of the Indian economy, the nature of monetary flows and ebbs in this economy are different from what happens in a lot of developed economies. So I think that there is room for entrepreneurs to create products, services, all kinds of things in this space that we need to bring into the narrative. I'll stop here because we have far more erudite people to speak.
Thank you, sir. But that, I think, frames the debate very eloquently. And I think, Dr. Arno, I would also ask you about narratives, since you have seen them globally. You've seen the whole narrative on cryptocurrency evolving globally from when it was seen more as a menace to, what it is seen as now, and how the evolution of dialogues has happened on CBDCs as well. So could you throw some light on how has the policy thought process globally evolved on cryptocurrency, let's say over the last 7-8 years?
Thanks for that. And yeah, I think Dilip is exactly right. I think if we're going to highlight two different things, I think one is this idea of technology and using it to build better infrastructures, better systems, in particular, better monetary and payment systems. And this is something where India has already been doing a great deal of work, but this is in many ways next stage technology. And this, I think, is something that we're seeing all over the world. You see the original moves as sort of challenges, but then you see increasingly the adoption and use of cryptocurrencies by governments and states. But the second, and this I think is really important, is the idea that when we are talking about blockchain and about transactions, ecosystems, environments, core to making these work are trustworthy monetary instruments that can be embedded in transaction structures. And there's a very important role in making sure that one has a robust, trustworthy, efficient, safe, effective monetary instrument to embed in blockchain transactions, because the structures have, as Dilip says, huge potential for innovation, development, and making many other things, from security settlement to supply chains to proof of origin, much more effective.
Great, and I think there's a lot to unpack there. And I think coming to the monetary questions, we could not have a better expert in-house. And I think, Dr. Goel, I think this is a question that I think a lot of people in this space would like to understand. How is currency really managed? And what is it about cryptocurrency that is so dangerous to the conduct of monetary policy?
Crypto has, as Dr. Arner was saying, many sort of technological advantages in innovation. But to call it a cryptocurrency is a misnomer, because currencies are normally backed by sovereigns. Now, this is no sovereign backing. I think Dilip was telling us that it's a fight for freedom. But unfortunately, if you look at history, most of this free banking and non-backed currencies have ended in collapse and tears. None has survived. And it creates a lot of dangers for the unwary investor who comes in. Now, to call it a currency is a misnomer, because suppose you're going to buy a cup of coffee and you need to pay with cryptos. And by the time you finish the crypto, the amount you'll have to pay will have changed. It's so volatile. So therefore, the function of, as a medium of exchange, it is very, very unstable. And although there are variants being developed, stable coins and so on, but their backing is uncertain. Then if you want to use it as a unit of account, again, it's so volatile. Store of value again. So it's primarily coming in because doing so well because people are buying that asset. They believe other people will buy it and its supply is somewhat limited, at least the original Bitcoin, and its value will go up. So it is a speculative asset in that sense. And if it collapses tomorrow or it loses value, you have these sort of tulip mania we know in history where people just come in and then it collapsed at some stage and left. So people need to be, that is why regulation is really needed here to clarify what is a crypto. It's not a currency, what it can be used for, and where, the financial stability aspects, monetary stability, there's a large shift towards cryptos from the traditional domestic currency, then it really affects monetary policy adversely, can create instability, affect the exchange rate. One of its advantages is ease of cross-border transactions and low cost. But if there's a sudden flight from the currency, that can again create a lot of instability. So you need, and if it is an asset, it needs to be taxed like other assets. It needs to be investor protection and so on. So there are a lot of very interesting regulatory issues. How you clarify that it's not money, it's not currency, it's something else. And what are the kind of regulatory issues? I think your report has sort of brought out some things. Thank you.
Thank you, ma'am. And I think the other aspect on this whole debate is, of course, the one on national strategy, national security, how you sort of treat how do you treat your innovation ecosystem vis-a-vis what other countries are doing? I think that's a very a big undercurrent in all the thinking around policy. So on that, Mr. Chaudhary, it would be great to understand from your perspective, how do you think countries should think about cryptocurrency in terms of national strategy, or how are they thinking about it currently, even in India?
Thank you. Yeah, I think it's pretty well known that one of the reasons that India reversed, or the government supported the decision to reverse the RBI's original ban on crypto, was not only the Supreme Court decision, but because the national security apparatus in India came in and said, look, China is launching a digital renminbi. Something here is going on that we need to be part of. And I think what the nature of crypto currencies, what we're looking at internationally is one, as others have mentioned, that some of it is going to be difficult to trace. But the point is there is already massive offshore trading in crypto from by Indian investors. And there's very little the Indian government can do about it. So if you decide to ban or over-regulate crypto in India, you're going to see a lot of that money still being transferred overseas to places where you cannot regulate or monitor. So it's better, if you wish, to have it inside the tent rather than outside. Second, if you can focus on blockchain or encourage blockchain-based crypto, you at least get a transaction line so you can tell where it's going or where it came from. And it's much easier to work out if it's going to be used by a terrorist or used for gambling or something else like that, or where it's going at least. The other point is that other governments are already working on it. So if you look at what the Bank of International Settlements, the so-called Model 3 group that's working on a cross-border digital currency structure in which UAE and various other countries will essentially acknowledge each other's central bank digital currencies. You can already see what's going to happen on remittances, for example. The UAE is a huge source of remittances around the world, and definitely for India. So we have to be, again, part of that story if we are going to be able to understand what's going on there, and also figure out what type of capital, where is it going, and why is it going to where. So for a whole set of international reasons, we cannot afford to not be part of the game. It's going to be difficult. The tulip bubble was mentioned. The dot-com bubble, I think, is even a better example of where money just poured into companies that didn't make any sense. But the net result was a new technology, a new set of technologies in the ecosystem that was relatively stable and which governments learned how to handle. And that's what we're going to have. That's the passage we're going to have to go through. So far from anything avoiding crypto, the government has to work even more, not only within its own internal agencies about how to handle this, but it has to work with other governments and how to work with this. And I think you saw this morning, Prime Minister Modi announced that besides avoiding any talk about banning crypto, he just says that democracies of the world have to work together to monitor this and see that it doesn't cause problems. And I have a suspicion that I would put a side bet that in the next 2 or 3 Quad summits, we're going to see crypto as part of the agenda.
Yes, and I think it's amazing that at our event we have 2 of the largest democracies also presenting on their regulatory approaches. So just in about an hour, we'll be hearing from the former Undersecretary of the US Treasury, who managed all oversight over financial crime, the FinCEN, the OFAC, the FATF. And we'll also be hearing from Japan's FSA, the director there, who's been integral to all their work on managing ICOs, exchanges, exchange hacks, self-regulatory organizations, and a lot of these concepts that have been coming up in the Indian debate. So I think now I would like to possibly dive a little deeper on particular buckets of issues. So if we take the one that has come foremost in India, which is the issue of investor protection. Investor protection and a whole host of market risks around it. Who are the players? What are they selling to people? How are they managing that? And I think there, Dr. Anna, you are the expert on these issues. Can you tell us about certain models that are being recognized globally to sort of tackle trading, tackle investor protection, tackle the regulation of exchanges? Any light you can throw on that?
Yeah, I think what we're seeing is a recognition that some of the real challenges are around fraud, manipulation, failure, these sorts of aspects. And these actually are very long-term focuses of financial regulation, of consumer protection regulation. And as a result, particularly to the extent that you are talking about something that has an investment element. And of course, you're differentiating between different things depending upon their nature and function. But some instruments are very much investment products. They're meant to be investments. And I think increasingly the view is that as a result, one needs a regulatory framework that treats them in the same way as other regulatory frameworks. Often where you start is in the areas where we see the greatest risks. And the greatest risks that we tend to see tend to be where concentrated trading activities take place, and that's the exchanges. And so we've seen an effort through a number of international organizations to build frameworks to bring exchanges into the regulated environment. And it has to be said that many exchanges are moving in this direction for the simple reason that it's in their self-interest, that if an exchange is regulated, that enhances its trustworthiness from the standpoint of consumers and users, which is in turn beneficial from the standpoint of its business. So we're often focusing on exchanges because of the key role they're playing. And we're also often looking at things like cybersecurity and custody. If you think about some of your biggest risks, if you have an exchange that collapses, what actually happens to assets of users of that exchange? And of course, we have had a number of circumstances where the protections around those assets was quite poor, or where the assets have disappeared, been stolen, et cetera. And so we have the opening areas from an investor protection standpoint tend to focus on the exchanges. And I think increasingly on disclosure, we're developing accounting frameworks, we're developing transparency frameworks, and on this idea of custody and making sure that the assets that an individual or customer thinks that they own or control are actually there.
Wonderful. And I think a lot of these are, at least some of these are key concepts, even when it comes to the solution we'll be discussing here. I think one aspect that maybe is fairly unique to the Indian debate is something that we hear a lot today is about the misleading of youth and, any kind of false claims or, any kind of messaging which is unethical or deemed inappropriate, with regards to these assets. So any views here from the panel on this issue? What do you think is fueling this issue? I mean, why are so many people jumping in, even though the state has not given a green signal? What do you think is actually missing? Why is this happening in our country? Yeah, Mr. Cherian, you had some comment. You're mute. Okay.
Oh. Yeah. Okay, I'll try and take a shot at it. I think the reason why there's excitement about it is a bit like what is happening unnoticed by many is the concept of growing day trading in stocks. we have a very large number of people, especially young people, who are technologically savvy and who have probably less hours of employment, if any. And I think that they think it's a shortcut to short-term riches. I think Ms. Goel mentioned the fact that there could be the danger that you would have a whole bunch of people charging into this area and then being deeply disappointed at the least and horribly duped at the worst. There's that problem, and that is a problem. And unless it is backed by some reality, in the case of day trading, there are real stocks, and there is a SEBI, and there is a exchange which is controlled by very stringent regulations, which make sure that even if there are losses, they are contained within a day. I think that is probably, I would say, one of the reasons why there is excitement in this. And the second is clearly the fact that because it is at the cutting edge of a new reality, the new metaverse, as it were, those who don't want to be left behind feel that if you enter on the ground floor, the chances are that you might be able to exit with a neat package. As Ms. Goel said, the chances are that people are chasing a chimera. But hey, that's the nature of the kind of people who are involved in this. Now, does the nanny state need to protect them? That's a question we all need to consider. I'll stop here.
Okay, and I think coming to this aspect of what are people investing in what appears to be a chimera, right? It doesn't seem to be solid, right? And here as well, also like to ask you, Dr. Goel, how is this sort of fitting into the monetary policy thinking in India? Because we know there's a lot of instability ever since COVID started. There's been just so much that all countries have had to deal with economically. And there are so many priorities which have taken precedence over this. And I think quietly over the last 2 years, it has grown very rapidly when maybe a lot of people were not looking, right? So could you help us understand what have been the larger priorities of India monetarily? And why is it that this issue was maybe not considered very actively right now? What is it that is important for the Indian state right now, and which takes precedence over all these matters?
I think Dilip was right that this has really grown because there's so many, lockdown and people sitting at home with computing facilities, something new happening they can participate in. That is one reason it has grown so much in India, I think, in the last 2 years. But internationally also, this really boomed after the GFC and the sort of debasement of currencies, where people felt that currencies are going to lose value, then cryptos might be safe. It's like people move to gold whenever there's high inflation. So but at least gold is held by central banks and it's a well-regulated kind of market. Here, there's absolutely no intrinsic value, maybe apart from the technology and freedom, if you want to say that. So I think for monetary policy, it is a sort of competition in a sense. It's another currency that, and if there is a flight from domestic currency to this, it can, I think the IMF has also warned it can create a lot of instability. And this is worldwide, because we are seeing that some countries which have very already dollarization, nobody wants to hold their currency, have adopted crypto as their national currency. So, I think in that sense, it makes policymakers pull up their socks and make sure that their currencies are doing well, inflation is controlled, etc. But otherwise, the advantage of cryptos is this ease of cross-border movement. And this whole thing about a central bank digital currency. And India, again, has an advantage here that with the UPI that we have developed and the whole innovations in the digital space, we are on the way to this. So that is one aspect, and so I think that on the whole we are well set to as a country to have some substitute for cryptos, but they will continue to be attractive as an asset. The other thing is the transparency, I think, in regulation, and we still have capital controls. Therefore, if this can lead to a lot of transactions which are not consistent with our rules, and their regulation must come in, and because cryptos can be very transparent if they are well regulated. If they are banned, it becomes a black hole, as I think Mr. Chaudhary was saying. So that is why you need good regulation. You can trace what is happening, and there are warnings, as well as for the limited purpose that it is safe for investors who know what the risks are and who want to get into it, not young people who are just doing it because it's a fashion or they have spare time. They can do it safely. There's investor protection also. And you have regulations to prevent a violation of domestic rules, kind of capital controls we have, etc.
Yes, ma'am. And I think we're looking forward to the discussion on a solution where we're actually covering a lot of this and looking at an innovative way for India to do it. But also, ma'am, just one more aspect which I did want to ask you about, and there were some questions about, is on inflation itself, right? Since that has become notionally a sort of driver for people to move into assets like this. What is your outlook on inflation? Like, we've been seeing reports from the US, and now it was expected to be transitory, but now inflation is here. Could you throw some light on this?
I think we need to dissociate Indian inflation from US inflation. So in the US, because there's been a huge fiscal stimulus and very rapid recovery, so that the output gap has shrunk, and there are more vacancies than there are people, there to fill them. People are resigning en masse for some reason. They don't want to work. They have found new values. So all that makes for inflation to be somewhat more persistent than was expected. Because initial research did show that most of the inflation was in, say, oil or commodities that were affected by container shortage, the sort of snags that we saw in trade. So, but overall, I think the one big point to remember is that most countries, including are in some kind of an inflation targeting framework. The central banks are bound to respond if inflation exceeds their comfort zone. In a way, the US was working towards inflation exceeding its tolerance band because it had been below for so long, so to average it out. So they have accepted a rise in inflation, but they will react if it is sustained or looks persistent. So I do not think inflation is going to be persistent like in the 70s. Even for oil, there is when we go beyond the winter, we will see, because the shortages have led to a kind of, where markets are building in and therefore raising prices, etc. So we might see, most futures show that oil prices should fall over the next year. So I don't think this inflation, and in India, food prices have always been a major cause of inflation. But we are seeing a lot of action there. Food inflation has been somewhat contained. The sticky inflation we are seeing in core is where global factors come in, such as oil prices and so on. But we're seeing a tremendous increase in energy efficiency, so that we can absorb a higher oil prices without it necessarily being inflationary. Recently, we've had this cut in taxes. So if there is two-way movement, then it is a transitory thing which you can look through. The oil price inflation need not affect core inflation, and therefore inflation persists. But the one point is, people should remember, in inflation targeting regime, there's no way inflation can become persistent.
Yes. Great. And I think also in terms of that threw a lot of light in terms of how, in Indian policy, we are thinking about these issues economically. And I think from a strategic perspective, I would also ask Mr. Chaudhary, how are Indian policymakers thinking about the tech race, or cyber security? What are major Indian initiatives there where you feel, crypto somewhere might feature in the thought process?
I think is what Mr. Cherian had said earlier, and the others had said, that we have built this enormous digital financial infrastructure, whether it's the UPI and various other things. So the next step, obviously, is going to be the crypto side of it. But my sense is that policymakers accept that that's where they're going to have to go. Sorry, but they don't know exactly how to handle this. Because at the core of a lot of this is the fact that crypto eradicates a lot of the financial intermediates. And for example, things like terrorism finance is handled by going after the intermediates. That's where you're disciplined. FATF had to release a report recently trying to see how they could balance this. And they did say, actually, no, you can monitor crypto if you fulfill certain obligations, as Dr. Goyal and others have mentioned, if you have distributed ledgers and so on and so forth running most of this. So therefore, it's feasible to do this, even though you lose a lot of the intermediates. That loss of intermediation, I think, more than anything, terrifies regulators, because it's not just in something like terrorism finance. The entire banking system is built around that commercial banks are the intermediates of the banking structure. So you could, in theory, the fear of bank runs and so on, because people then will come to believe at least that they have a personal account directly with the Central Bank of India if they happen to buy central bank digital currency. But then the role of the commercial bank in the middle of a crisis then becomes irrelevant. And then what happens to those banks? So a lot of the regulatory system that we have developed is built on the intermediates, and a lot of that is now going to slowly disappear, whether it's cross-border or domestic. So there's a recognition that this is happening, but there's no clear idea how exactly you're going to do this. And you can see why the RBI is so nervous, because the RBI looks at this and says, oh my God, a lot of our regulatory apparatus becomes completely irrelevant here. And rightly, they become very nervous, but the answer is not to ban. The answer is to change and try to figure out how to do this in a manner that causes the least amount of disruption.
Oh, that was very well said. The answer is to change. So on that theme, any final thoughts from the panel? If we have to change, and the state has to change, and I think Policy 4.0 is also based on that premise that the policy apparatus has to change because we are faced with a very new reality. Any thoughts on what is this change? What is India's place in this change? What is the Indian opportunity in this change? What's the opportunity for the Indian state? Any thoughts from the panel?
I think a couple of different things. The first is the idea that this is at the technology frontier. And so there are opportunities to continue in a direction that India is already going. The second reflects also a longer term strategy, which is looking at how one can build enabling infrastructure that will maximize the participation in the digital economy, and therefore maximize benefits across the country, as well as supporting innovation. I think the point is very well made that when we are talking about innovation, it's very rarely directed innovation. Innovation tends to happen when you put in place the elements that allow it to happen. But if you actually try to direct innovation to happen and control it, it very rarely works. And so I think that is often the challenge for policymakers, a desire to be able to control direction, but a reality that often innovation develops best when you build the environment and let it happen.
Yeah, if I can come in Very excellent points. I just wanted to add to that. This issue that banks are worried that they will be disintermediated, and policymakers are worried about that. It is true to some extent, I agree, but this is what happens with innovation. The people immediately affected are frightened, but an innovation creates new opportunities. For CBDC, for example, we know that the central bank is not going to be, want to deal with each household, and there is a distribution mechanism through banks. And I think China, for example, they are experimenting with different tiers of the currency, and where there is direct interaction with the central bank, where it goes through commercial banks. So as Professor Arnold was saying, it is really creating opportunities for more and more participants. That increases the backing and the acceptability of an innovation. And I think that is very much possible. And again, India has the advantage of building on all that we have done in UPI, which is really, and the digital stack, etc., which, for example, in tracing KYC, in reducing transaction costs for customers and keeping track of what is happening. We have, it's frightening for regulators, but I think we are well set among countries to be able to do this, that it's feasible to build on this that has gone before. Yeah, thank you.
If I may just add one sentence. Go ahead, Pramit, after you. Please go ahead.
Okay, so I'm just going to say that one of the, when we talk about crypto, we're looking at an entire spectrum of different types of technologies. You have at one end stuff that is not built around a distributed ledger, so it's untraceable, it's chaotic, the value goes up and down and has almost no tangible value. You then have something like Bitcoin, which at least is traceable, even if it's volatile. Now you're going to have stable coins. So Facebook will be launching, what is it called? DM, I believe it's been renamed. And I presume other companies will follow suit and so on. And then you, of course, have the central bank digital currencies, which will be, really almost replicas of the existing fiat currencies. So you have a whole set of them right now. Now, what's interesting is you've seen China already move and say, we're banning everything except the central bank digital currency, because they're a control freak state, and that's what you would expect them to do. But the point is that India hasn't gone that far, and if we don't go that far, that at least in a portion of that spectrum which China has moved against, we still then have an advantage because the rest of the world is not going to necessarily go down that Chinese path. And as Dilip was mentioning, you're going to have a lot of entrepreneurship built around some of what we see there in the stablecoin area and so on. And India, because it already has an ecosystem, a digital financial structure, can become a major player in that field. So you have to see an opportunity here that actually give us an advantage perhaps over China.
Fantastic. And I think the final word, Mr. Cherian, what is the India opportunity?
In one word, it's huge. As Professor Arno said, you cannot direct innovation. You can only create an enabling atmosphere. And I think all of us have echoed that. How much freedom that will have? How much space are you going to give it? These are issues for governments in some senses to try and figure out. But the one thought I have is that much like the entire country is agitating that there should be more women in parliament, for example, I think in policy making of this kind, it may be good to add a few very young minds who are working in this space into the policy making area, along with others with more experience. Because I think that we are on the edge of a new kind of system. Some of it we need to have regulated, some of it we need to allow to just be an enabling environment. And I think a combination of the two will be potentially extremely powerful force for India to unleash, given that we have the world's youngest population.
Wonderful. And I think on that optimistic note, we will close this panel. I want to thank all of you for your time. We are now moving into our discussion and unveiling of our solution. We're going to be presenting that. And following that, for everyone who's watching the live stream, we will have these keynotes from regulators from the US and Japan as well. But thank you so much to our board for all their time, and I'm sure everybody has taken away a lot from the session. I've been receiving messages from journalists even as we chat about these comments. So I'm sure there will be a lot of impact that this discussion has created. Thank you very much.
Thank you. Thank you.
Thank you very much.
It was good to
Thank
have
you.
it discussed in a substantive way. I think that's needed.
Thank you.
Yes. All right, great. So I think we heard from a variety of thought leaders from different disciplines about what they see as the risk and opportunity. And I think it's important to have this broader understanding as we enter into a policy solution for this. We also undertake this narrative within the country of what are the issues in crypto and what is the opportunity, what is the risk. I think there's a lot of difference that good debate can make. There's a lot of difference that the right questions can make. And I think this session was very helpful in actually doing that and helping us think from a variety of perspectives. So we've heard of monetary risks and the kind of challenges that were highlighted with exchange rate risks, with financial stability risk, with cross-border flows. We've heard of market risks, whether it's investor protection, whether it's the regulation of actors, whether it's fraudulent practices. We've heard from a national security perspective, national competitiveness perspective, how this is an opportunity where we can't lose in the competition to other countries. So with this sort of laid out on the table, we'll now unveil what we are very excited to share, which we believe is a very innovative approach and a very light touch approach, and honestly one of the first approaches in the world that is looking very proactively at this monetary risk aspect, on which the only precedent we've seen so far have been bans. So in just a minute, I'll be sharing my screen and I will be taking you through our presentation on this innovator framework for India. All right. So now we're moving on to the next segment, and I think the segment we're most excited about here at Policy 4.0. So we've heard the debates. I think everybody in this ecosystem has been hearing these debates for years about financial stability, about KYC, illicit activity. And while the technology has made a lot of progress, so has the regulatory capacity on it. And as some of our panelists were saying earlier, we really do believe this is India's opportunity, not just to make a name in this technology, but we also believe it's an opportunity regulatorily, just because of the capabilities the Indian state has built with unique identity, with payment systems, with very active digitization across all services. I think this is just a solution that's an extension of the India story, the India model. So without much further ado, I'm very happy to present to you and take you through our solution. I hope you can all see my screen. All right. So I will take you now through the context as well as the approach, as well as how we see this tackling issues that are raised across policy debates on crypto in India. An innovative crypto regulation approach for India, which is the India wallet. To start the context on it, we need to very well understand the policy risk framework around cryptocurrency, especially from an Indian perspective, but most of these are also true from a global perspective. So when we think about the debate on cryptocurrency, when we think about a legislation on cryptocurrency, it is something that has to address all risks together. It is not something that can only focus on the consumer protection side. It's not something that can only focus on, regulating certain actors in the system. It's something that has to balance a lot of these risks together. And what are these? So I'll take you through the different buckets of risks and how we've characterized them. So starting from the left with market risk, the one that is primary in the Indian mind is investor protection, and for good reason. I think for investors and retail investors, there are a variety of issues they face. You have the loss of keys, just because this is such a different asset. How do you actually secure and custody it? You have losses via scams and hacks, which I think all of us hear about these cases, and there are a lot of headlines around these cases. You also have issues because of unregulated industry practices. There are a variety of actors in this space. Many of them are not licensed in any way. Some of them might be registered as companies, but none of them have a proper framework. And so it's very difficult to know if practices in these different businesses are in line with what they should be. And then any issues that come around just investor education or, people, misleading practices are not necessarily only at a crypto business level. They often happen from people in this industry who are just maybe developers. There are a lot of scammers who are entrepreneurs of a different kind. So how do you actually protect investors from all such actors? Then secondly, you have the regulation of these industry actors themselves. So these are companies that operate in fairly different fashion. Some of them operate in similar fashion to existing companies. So if you take exchanges, crypto exchanges look and feel like other exchanges, but operationally they are quite different. In a crypto exchange, you have collapsed all the functions of different market actors, whether they are depositories or they are brokers or the marketplace itself. A lot of it is collapsed into one entity, which is the crypto exchange. And in that manner, it's very different from other financial institutions. And similarly, if you look at some of the emerging models, they are even more disruptive. So if you look at DAOs and things like that, how do you even regulate such an entity? Then you have market manipulation and fraudulent practices. I think this is fairly self-explanatory, but there are a lot of cases where, you know, the asset prices get manipulated, or you know, they are what we know as rug pulls in DeFi, which are very common, where you know, people lure investors into a project, making certain claims, having certain white papers, and then disappear with the money. So I think there's a lot of questions there on which there isn't much that has developed on all these questions, even globally. To some extent, there are practices, but not everything has been answered. Then the larger bucket of risks on the right side is on monetary policy. And that's where the real concern is for India. I think also for us as a policy body. I mean, the real bucket where India has to innovate and needs to really think outside the box is on monetary policy risks. And what are these risks? There are a variety of risks when you think about monetary policy and which ones are relevant to the context of crypto. We see these three as being main risks when it comes to cryptocurrency. The first, of course, is financial stability risk. And I think a lot of us have heard about it, even from RBI statements and you know, other literature you might read from the IMF or other bodies. Financial stability has to do with just, you know, your at an aggregate level, savings getting diverted to volatile assets. But also a whole variety of things constitute financial stability. So as we saw in the case of Turkey, which we'll talk about, they saw a big switch into cryptocurrency-based payments when their inflation went up. That's also a mark of financial stability risk. We'll discuss this more in the subsequent aspects of the presentation. There is also the exchange rate risk, where, you know, India has a capital controls regime to manage this. And some of our panelists also mentioned this. And here, I mean, you can have capital flight through crypto assets, which is when you have the outflow of this capital by untraceable means. And then it affects how you manage your, you know, your capital controls and exchange rate risk. And lastly, also on the cross-border flows, it's also important to have a check on the quantum and the value of assets that are moving in and out of the country. It's very important to manage your monetary policy, to manage any inflationary pressures. And that's also something that becomes sort of untraceable, unreported more accurately when you have cryptocurrencies. And then the other bucket of risks is on compliance and illicit activity. And this is where you have also a variety of risks. So money laundering, terrorism financing, other forms of illicit activity like dark net markets, and all of this have been brought up repeatedly in debates. These are definitely a risk area with cryptocurrency, where you can sort of mask money flows through cryptocurrency and make them appear as coming from a legitimate source, or you can just sort of route them through channels that there is no oversight on. And this is something we'll be tackling also in our presentation. And then on taxation and compliance avoidance, this is another debate that we've seen quite actively in India. There is risk of tax evasion and non-compliance. This is an issue with which our regulators are looking into, and which the legislation will also have to address. And the final bucket, which is not so much just a risk, but it is a risk in terms of opportunity cost, and that has to do with Indian innovation and competitiveness. And here there are a variety of things to watch out for with the kind of regulatory approach we take. The first, of course, is if we have a lack of agility and we have over-specification in the regulatory approach, that does not work very well in the case of assets assets like these, which are rapidly evolving and changing form, because this is a technology that's changing very fast. You need to have an agile approach to keep up with these changes. The second one is when you sort of lose out on investments, you lose out on attracting investments because we are following practices that are sort of uncompetitive compared to other countries. And so we are losing out on investments into startups or into companies or just into the market itself because of this reason. A third risk we face here is, I think, a big reason India cares about this technology is because of what it will unlock in terms of the next wave of growth or the next wave of large companies, the next Google or Amazon sort of getting set up in India and coming out of India. I think the inability to incubate such companies will become a challenge just because we have an onerous compliance burden. And finally, something that we already do see strains of in the Indian scenario is brain drain, and this is actually quite a challenge for, I think, all developing economies. But also, I think as we move into a world where we are moving into a knowledge economy, I think brain drain becomes a big challenge, where you are actually now competing to keep talent in your country because many countries have set up immigration policies and many incentives to try and lure high quality talent, to lure startups, and especially people in these sectors, as fintech, blockchain is considered very high value. So this is all, all of these together, we believe, are policy issues that are undercutting any legislative approach that we're taking to cryptocurrency. And this is important to understand, to frame the understanding of the solution that we are proposing as well. So with this understanding in mind of what are the risks and what are the various categories of risk, I will now move on to exploring what has been the global precedent when we look from these lenses of monetary risk, or we look at how other approaches are being, other risks are getting handled. What is the right approach for India to tackle such risks? Here, and we focus, as I said, very much on the monetary aspect because that is one that doesn't have much precedent globally. So to start with, global attention on monetary risk from crypto was not quite large earlier. I think for those of you who follow this sector, you would know that there were earlier these studies from the FSB that said that cryptocurrency is not really a threat from a financial stability perspective. And it is still not a threat from a financial stability perspective in most countries. It's not yet reached the levels of investments where it is a threat from a global perspective. But what has changed is that it is very much rising in ranks to become such a threat. And I think this has been a big shift that has sort of gone unnoticed for a lot of observers of this industry, for a lot of observers of policy in India. And this is tying very much into statements that the RBI has been making as well recently. Cryptocurrencies have just in this quarter itself, for the first time, been featured in amongst the top 10 risks for global financial stability by the IMF. And this is not something to be taken very lightly. I mean, the Global Financial Stability Report is the sort of landmark report around this. It has been It's followed pretty much by every major economy, by every major financial institution. And when they at their global level have said that the rapid growth of crypto assets is now classified as one of the risks, this is something that all central banks do sit up and take notice of. But the challenge here is that from a financial stability perspective, there are just very few precedents to handle the threat or the risk that crypto assets face. And the only precedent that we are seeing around the world is bans or partial bans. And a lot of these, as we are now seeing, have not been very effective. So just to give you an example, the most concrete example of this risk was from Turkey, where in Turkey in April, inflation had peaked over 17%, and that was a time when you saw cryptocurrency usage just spike in the country. You had over 600% increase in traffic at exchanges. People were using cryptocurrency to buy things. You had kebabs being bought for Bitcoin. You had gold getting bought for Bitcoin. And it really started destabilizing the currency further. And that's when the central bank stepped in and it banned crypto. It banned it in a particular way. It banned it from being used as a payment rail. But it has hinted, the central bank, that it will be bringing much further regulation which restricts cryptocurrency to a greater sense. So in terms of financial stability, what we saw was a ban, and the one example that happened where crypto started destabilizing the currency to a small extent was in Turkey. But after that, the trading activity does continue there. Crypto usage is not totally, gone away there. They are also similarly grappling with a full legislative framework, because it is well understood that bans are not very effective. And I think to give further example of that, we are also looking from the other monetary risk perspective, which is on exchange rate risk and capital control. So most countries in the world do have some form of capital control. The large countries, it's largely the US and Europe, it's the dollar and the euro, which are freely convertible, and a few other currencies like the Swiss franc and others. But most countries have some form of capital control. So what have these countries done? And I think there, if we look at precedents, you have Nigeria, which in February 2021 imposed very much a sort of ban, and the central bank in Nigeria has been very clear in terms of their disfavor of cryptocurrencies. However, despite the ban, when you look at on-chain data, it's very evident that trading is actually quite high in Nigeria, even despite a ban and statements by the central bank. And on paper things are in place, but in practice they are not, right? And in South Korea as well, there was a period where cryptocurrencies were under prohibition. But then the Korean government has since then also brought in legislation to try and regulate the space better. They've moved away from that prohibition. They brought in legislation, they put in caps in terms of the purchase quantities, but there as well, you're seeing issues in terms of how, the issues exchanges are facing. They're not really able to comply. They're not really able to manage the sort of compliance burden that's being put on them. So there's not too much when we look around the world in terms of, definitely in terms of effective action. But we can say that monetary risks are rising, and the few precedences we've seen are on ban. The country with the absolute ban on cryptocurrency, which is a recent development, is really China. But if we really look into China's example, it becomes quite evident that they have brought cascading bans on different aspects of crypto trading, but these have been quite difficult to enforce. And each time they come into place, there is this backlash of activity which goes on unnoticed, unreported, untackled really. So if we see starting from 2013 until now, there have been repeated bans. And I think one of the biggest crackdowns came post the ICO wave, in 2017-18, there was a very large crackdown on crypto players. And in that period, after the crackdown, for the next year or two, China very much had the highest volume, one of the highest volumes of illicit cryptocurrency activity occurring there. In the years following that, China also had very large cases of money laundering. Many of these went undetected for multiple years. Some of them were later reported and tried through court cases, but there really wasn't much of a capability of tracing this activity. And even now, when Chinese mining has also been stamped out, it's been very difficult to sort of enforce that on ground. So there have been many reports of stealth mining operations. People sort of mask this kind of industrial activity. There are home-based miners who are switching to POS mining. For those of you who know, that's the proof of stake protocols, which are less energy intensive to mine. People are switching to that. And it is becoming harder to detect the activity because you have no way to tell who is mining when and what. So it hasn't been very easy. It hasn't been very smooth. Banning has been difficult. It has sort of led to more illicit activity. And it basically is unable to really stop the very criminal nature of activities from happening, which is the purpose of strong regulation like that. The other trend that we're seeing, which becomes very important when we're thinking of the legislative approach, is decentralization. So I think at the moment in our debate, we are relying quite a lot on compliances that we will place on the centralized actors. But what is not really getting understood is that the percentage of centralized actors in this market is also reducing. And a lot of activity has moved to decentralized finance, where there really aren't intermediaries. And so if you've seen the nature of functioning of an exchange, this is perhaps a centralized exchange. It can have compliance with the government. It will have its market makers. It will have its brokers. And there you can levy a degree of compliance. And in case of a DeFi exchange or a decentralized exchange, it's really the smart contract that has replaced most of these actors. You just have the buyer and seller transacting through that. You have price oracles, which are also software, and they are giving you price feeds and accurate price feeds. And you have matching engines, which are not run very much in the exact same way as you have in centralized exchanges, because the governance of these things happens also in a decentralized way. So in such a scenario, it's very difficult to tell where you levy the penalty, and all data handling does get replaced by these smart contracts. So DeFi is quite a big global trend. It is also large in India, and because we don't have accurate reporting, there's not too much by way of accurate data, but you can tell from these graphs in terms of total value locked in DeFi, it has skyrocketed, especially since early this year. All over the world, it has skyrocketed. In terms of the number of users, that has skyrocketed all over the world. And I think data from 2021, I think about 2-3 months ago, data says that from India alone, you've had values of close to like I mean, you've had 2,500,000 just website, but sorry, this website visit data is the one that's confusing. The website visit is to DeFi protocol websites. I was just trying to check on that number. 2.5 million website visits. These are like Uniswap or one of the DEXs, or people visiting the application of these sites. I mean, of course, a lot of activity could just happen through nodes themselves, but also the values sent have been huge, right? So you have close to $1.2 billion, $1.25 billion being sent through DeFi from Indian users. This is, this is definitely not activity that is reported anywhere or captured anywhere, because it's not being handled through any actor. So this is a concern. I mean, it's not something that you can manage just by placing restrictions on ads or anything. This is not happening because of ads, right? Decentralized protocols are not running ads in the paper, but a lot of value is moving through them. We had data from centralized exchanges, which was valued all India at about 6 billion. So this is 1.25 billion. So it is, already a significant portion of that. So this context setting is something we spent time on just to really emphasize that there's not much that exists in terms of global precedents to tackle all the risks for India, nor are the existing ideas that we are putting on the table sufficient to target that. Simply, and let's go through them, one by one. So when you are talking about classifying crypto as a commodity, that is something that, yes, you have frameworks for dealing with commodities. There's completely laid out frameworks for how those things get traded, how you maintain oversight on them. So they can tackle market risks, they can tackle some compliance risks, but not everything is really a commodity in crypto. It's going to be difficult to classify cryptos as that, but also doesn't tackle the KYC problem. It doesn't tackle the problem of illicit activity, of financial stability, of systemic risks and capital flight risks. So it's not sufficient to tackle a lot of the major risks and questions that are being thrown. If we also think about maybe activity not happening in India and just moving it all abroad under the LRS scheme, which was one of the suggestions of the central bank earlier, that's also something that's not enforceable because of DeFi channels. There is no way to then move activity into a certain just an LRS identified route. It's also not something that will give the government any oversight on illicit activity, nor will it give you any sense of how much money is moving into this, which is very essential if you're trying to manage monetary policy effectively. So this is not really something that's going to prepare India very well for the monetary risks that may arise. And actually, it could just make India more vulnerable monetarily if money is leaving your country and you have no idea where it's going. And thirdly, this approach, which has been a global approach of identifying WASPs and placing all burden of compliance on the WASP, is sort of faltering because there has been growing decentralization of crypto activity with the rise of DeFi and NFTs. And lastly, something that we very much believe is if you are trying to regulate crypto, you have to have a mix of technology and regulation. So if you are just making laws on paper and you're expecting full compliance, that's very difficult to enforce because it's just far easier to bypass controls. So unless you have some stake in on-chain activity, there's not much that you can do in terms of regulation. So in essence, there isn't really a regulatory approach or precedent that exists, which is capable of handling all the risks that are posed to the Indian economy by crypto assets. So how do we think about this? What is the approach? And for that, we need to understand some things at a fundamental level. We need to step back perhaps from the lens of the way we look at financial regulation, financial assets, and understand crypto really for what it is. And all crypto assets are just keys. And I think this is the most fundamental message that needs to be understood when we're thinking about this technology. Crypto assets are just keys. This is what a Bitcoin looks like. It is just a public key and a private key. This is what an NFT looks like. It is just a public key and a private key. If you have $1 million on chain in a certain asset, that looks like this. It is just a public and private key. And if you have $10, it just looks like this. It is just a public and private key. So keys are very central to the whole concept of crypto. It doesn't matter what kind of asset it is. It is just a pair of keys. And what are these keys? There's a public key, which is the one that's visible on the blockchain ledger. It's used for identification. And this works for identity on the blockchain. The major challenge is that this is not an identity that translates into a legal identity. And there is the need for a KYC bridge here, which there have been many discussions on globally. The private key is really the heart of the asset is the private key. This is the one that's known only by the owner. This is the one that enables ownership of the asset. It's the one that enables transactions with the asset. And all transactions, all the flow of movement, whether it's with an NFT or it's with trading a token, all of that is possible only when you sign your transactions through the private key. And these keys and the custody of management of these keys are then what become very important and very central to an innovative regulatory approach. And just to emphasize that, why we need to try and step back from just defining and over-defining the asset. Defining the crypto asset and the cryptocurrency is a global challenge. It's not just something that India faces. It's not like countries that made the broad classification of frameworks find it easy to keep accommodating these changing, emerging asset classes into that. They often have to revisit these frameworks. Yes, they are broad categories, but many times these are disputed and they are not very easy to fit different token types into. So this is a big challenge. It's a big question. And global experience sort of confirms the struggle. If we look at the case of classifying Ripple, for example, as a security in the US, right? There are those who will say it should be a commodity, it's fairly decentralized. There are those who will say that the original owners controlled a larger stake and it does classify as a security. And it's not very easy to classify these tokens looking back at the frameworks of existing financial assets. And this kind of lack of clarity, if it persists for too long, it really hampers innovation because the industry moves very fast. You can't be spending excessive amount of time on just trying to classify what it is that you're dealing with. And so the first phase of regulation that we believe can really focus on the more pragmatic question of the control or the custody over public and private keys, and just how Indian citizens can manage that in a particular way. And the second phase can then take a more gradualist approach and start defining specific nature of tokens in the specific context of use cases, because we know that's a case-by-case process. It's a very slow process. That is something that can start after you have put some kind of ring fence or some kind of channel into broader cryptocurrency activity, even before you get into what use case it is and how you classify it. And for this purpose, if the government believes that a default characterization of tokens as commodities is the way then that can serve as a baseline for now. But the real focus in the first phase is to really start identifying what is Indian activity in crypto. And here, as we iterated before, the keys are really the key. And the key for India in doing this effectively is in the identification and custody management of keys. So as we already discussed, there's a lot of regulatory debate focused on defining the rules for crypto based on its functions and activities. However, there are issues in enforcing laws like this because there is a cross-jurisdictional nature to this asset. You can kind of arbitrage where it's based, and it's also continuously evolving asset where it starts off maybe centralized and gets decentralized. It has one use case today, it will have 5 tomorrow. And if the same asset has 5 different classifications, that is quite difficult to then reconcile legally. So if we step away from that and we realize that all cryptocurrency activity is possible only through the usage of public and private keys, and we understand that the bulk of public-private keys, they are custodied and operated through software wallets. And the key infrastructure used to manage and operate these key pairs are cryptocurrency wallets. Then we have a different starting point for the regulatory debate. So wallets are a very multi-purpose instrument when it comes to crypto. They are a key point where identification of people happens. A wallet address many times is your identity. The authorization of transactions that happen often gets signed through your wallet. And it also manages to integrate and transact with various different blockchain applications. So if we are trying to build a standard process across asset classes, it has less to do with the use case and definition of the asset, but it has more to do with the process of custody and operation, which is very standard across classes. So if our big premise in developing the solution and what we believe is a big shift in the regulatory approach that countries are taking is that the regulatory focus should be on wallets and the onus should be on citizens to get a verified wallet. And then compliance becomes a matter of businesses onboarding verified wallets onto their platform and managing their reporting and compliance in that manner. So what does this wallet look like, and what is it that this wallet does, and how does it protect the privacy of citizens? Does it become a big government infrastructure, or is it a public-private infrastructure? These are all questions that we will look at now. So just to reiterate, wallets, as we said, they are sort of your gateway into cryptocurrency applications. They are in a way what you use to sign in. So if I go to Uniswap, for example, I connect wallet, and it's only after that that I'm able to trade, right? If I go to OpenSea and I want to buy an NFT, I will connect my wallet, and that's when I can access that marketplace. That's when I can start operating in that marketplace. So wallets are your passport into cryptocurrency applications. So you can sign in or connect using that. Wallets are also your identity in an application. So if you see once I'm signed on, this is my username, it's just my wallet address. That is my identity. When I'm sending money or receiving money, I am also signing that transaction, or I'm authorizing that transaction via the wallets. The wallet becomes the infrastructure, which is very much sort of like your gateway into crypto, and it becomes the level at which a lot of key functions that are important from a policy perspective occur at the level of the wallet. And what kinds of wallets are there? There are many types, and they differ based on certain parameters. So you have, in terms of the number of cryptocurrencies they support, you can have blockchain specific wallets, like you will see certain protocols that have their own wallet and it only works with their protocol, right? Or you have multi-chain wallets, which can integrate with a whole variety of blockchains, which can custody keys for a variety of blockchains, and they can perform this function. Then you have the storage method. So you have custodial and non-custodial wallets. So if you have custodial wallets, these are ones that have private keys, sort of owned by the wallet. They are stored in the wallet. So even if you lose your keys, they get recovered. Most exchanges that operate in India, all exchanges around the world, mostly run custodial wallets. Non-custodial wallets are where you hold your key. The private key is not owned by the wallet. The wallet is just sort of giving you an interface or a shell to sort of operate with your keys, but the actual private key is held by the user. And then you have wallets based on the network connection, or sometimes even just the type. You have hardware wallets and software wallets, you have hot wallets and cold wallets. And these are less relevant in the classification that we're looking at. But it's important to understand that there are a variety of wallets, there are a variety of players who make wallets. This is a fairly advanced industry in cryptocurrency. But this is the point that is closest to the user, and it is the one that performs the maximum functions. So what is the solution? What is the thing that can tackle a lot of issues? That is, from our perspective, we believe a very comprehensive way to tackle a lot of issues that India faces is to have an India wallet. So the India wallet is a one-stop tool that ring fences the risks, and it manages domestic and cross-border crypto activity occurring by Indians. So this is a tool that can help you segregate what is Indian activity and what is foreign activity. It can help you have some semblance of just oversight over the kind of integrations that are happening with Indian users, the kind of transactions or the kind of activity that is taking place via Indian users and Indian account holders. So this wallet is a one-stop tool. It forms a sort of foundational infrastructure, and it works for all kinds of crypto activity, whether it's through centralized players or it's through DeFi platform or it's an NFT marketplace. For all of these, the wallet works. It doesn't matter if the definition of the asset changes. This as a tool still holds. So this wallet has multiple features. It is KYC compliant, right? So this is a wallet where the KYC of users is done with all the necessary documents that are required under Indian law. And this is managed in an encrypted way via the DigiLocker. And we'll speak about this in just a second. This is a wallet that also manages cross-border flows, which are one of the largest concern areas. So it's something that can differentiate between what is domestic and what is international, and it can keep track of monetary risk and illicit activity risk. And finally, it becomes a sort of gateway for all crypto businesses or crypto protocols or large institutions that sort of want to transact with Indian users. They simply integrate into the wallet and they build a sign-in process around the Indian wallet. And it's a very seamless way in which many different crypto players around the world can work with the Indian market in a compliant way. So let's understand this wallet a bit further. What are the features of this wallet? Like, what does it do exactly? So the India wallet is a multi-chain wallet. It's something that works for most of the large protocols. I mean, conceptually, we are conceptually defining this. It's not an actual app. I'm conceptually defining what this wallet would do and what its features would be. So it would be a multi-chain wallet. It is something that would work for most of the large blockchain protocols. It is something that will work for a variety of cryptocurrency activity. whether you're dealing in tokens or coins, so it can store your coins or your tokens, it can store your NFTs, it can help you engage in any kind of DeFi trading, if you're holding staking or whatever, that can be operated and managed from this wallet. So whether it's tokens, collectibles or coins, all of these can be held in the wallet. The wallet can also integrate with almost every sort of crypto application that's out there. So it should be able to integrate these applications, whether these are crypto exchanges, such as those that operate in India or those that operate internationally. If people are trading through this LRS route, it is a wallet that can integrate with different exchanges. Many marketplaces or applications can set up a simple integration on their portals for it, the way they do for every other wallet. Just like you have, as we showed in the previous slide, just like you have MetaMask sort of engage here, I can go to OpenSea, I can pick a variety of wallets. Similarly, there would be an India wallet is what we envisage. And this wallet will manage your sign-in and your transactions with different applications. It's also something that can differentiate between domestic and cross-border transfers. And this is very integral when it comes to looking at monetary risk. So how does it exactly do that? For that, let's understand the KYC process that should occur to set up this wallet. So there is a KYC, a one-time KYC that would happen at the setup or at the time of setup of this wallet. And it would be, if you see the flow of it, there are many countries which don't have digital identity, as we know. There are these frameworks of verifiable credential providers that can be considered in these countries. But in the case of India, we have the UIDAI, we have DigiLocker. These are quite capable and equipped of providing such KYC verification. And the DigiLocker can provide a consolidated sort of crypto wallet verification service to all the wallet players. And this can combine multiple credentials that policymakers can define as being essential to cryptocurrency activity. So you may think the Aadhaar becomes essential because it authenticates your identity. It also deduplicates wallets. Your PAN becomes essential if you have to enable tax compliance. Your bank account becomes essential if you have to enable payments for crypto services. So all of these can together be consolidated into the crypto wallet verification service, which is something that we could have DigiLocker run. So the Indian citizen directly would provide the necessary documentation and submit valid the valid versions of their Aadhaar, their PAN, their bank account. These would be submitted by the necessary regulators into the DigiLocker and identified as verified documents for the citizen. Once the citizen has these documents in place, then he is enabled for this crypto wallet verification. And once the citizen raises an request to set up his wallet, the wallet service provider then verifies this via DigiLocker and then approves the wallet, approves the setup of the wallet. And if the documents are not in place, that loop goes back to the citizen and he has to make sure these documents are there in place. So this whole KYC process is something that's handled separately. It's something that's done at the wallet level. It's something that's done through secure services. And if needed, you can also have sort of periodic updates of this. It is just a one-time KYC process, which is seen globally as one of the most efficient and light touch approaches, rather than having every transaction verified, right? So this is just in terms of the setup of the wallet. Once you have an approved wallet, now you can engage in a variety of transactions, right? So how would this wallet work? So the user has initiated his KYC, and he has generated an India wallet. This wallet then will be able to push whatever transactions he has to onto different blockchain networks. This wallet would have integration to different crypto marketplaces and exchanges and different applications that he's transacting with. And this wallet, if necessary, can also have oversight if it's necessary at a regulatory perspective. But otherwise, the identity of the citizen would be kept encrypted. This linkage between the identity and the wallet would be kept encrypted. Okay. Sorry, I just lost connectivity for a second. So a couple of things to understand about this KYC. This is a KYC process that's sort of done at the back end. It's done separate from the business. So it's not a KYC that's shared around very actively. It is the linkage between Indian citizens' identity and the wallet is something that's kept encrypted. At least in our recommendation, we feel very strongly about the privacy aspect of this. So broadly, this is a broad functioning. Now, depending on whether we have a custodial or non-custodial wallet, there will be differences in the way this flows. But this is a broad thematic representation of how this wallet would work. So in terms of thinking about how it would work, there are a variety of questions, and I think we feel that a lot of these are different policy questions that will have to be addressed when thinking about building something like this. So the first question is, should the India wallet be a single government operated wallet, or should it be something that is operated by multiple wallet players? It's a private sector run thing, very similar to the kinds of wallets that we have today. And here, this is an open-ended question, and from our perspective, the wallet could be a new infrastructure that the government creates, but it could also be a technical standard that they set, according to which many of the existing players could modify their wallets, or they could build new wallets. More importantly, should the India wallet be a custodial or a non-custodial wallet, in the sense like, should it hold the keys of citizens? Which we think is a very big policy question that has to be addressed. So the trend in the cryptocurrency industry is for non-custodial wallets where people own their keys. And if we see a KYC process is possible in both scenarios, you can have proactive alerts around capital controls, illicit activity, and other aspects with both scenarios. However, if there is a movement in the direction where regulators believe that transactions have to be stopped preemptively, or there's illicit activity where we have to be able to stop it from sort of going through, that's something that's only possible with custodial wallets. But the flip side of that is that custodial wallets also have greater cybersecurity risks, right? Because you're now holding keys, and that becomes very prone to hacks and things like that. So this is a larger policy question that would need to be addressed, that would need to be thought through, that would need to be debated. And thirdly, how do you manage privacy with a wallet? Because as we also addressed in our opening panel, there is actually a fair amount of transparency when it comes to cryptocurrency activity. At the transaction level, there is a lot of transparency. It's only the identity piece that stays anonymous or pseudonymous. So if you are adding identity, then how do you manage the privacy and the right to privacy? One is this KYC process will be much lighter and more streamlined, because they only share their documents with the DigiLocker. So they do not share their with cryptocurrency. So this is a one-time KYC process that is handled through a secure channel. The second piece that we believe is this linkage between KYC and wallets is something that should be kept unencrypted. It is something that should ideally only be decrypted and shared pursuant to a court order, or if there is some concern of criminal activity or there's an investigation, that's question that also remains is, what do you do about other channels that people use to get access to cryptocurrency? So quite simply, the biggest reason why you would consider making a recognized channel, a legal channel of access, is that this is a channel that will get recognized under Indian law. This is a channel where, whatever crypto assets are managed through this channel, are routed through this channel, are recognized under Indian law. They're legally protected under Indian law. What is the case that we saw also in the legislation draft that had come out in 2019? Most activity was deemed black money, or it was deemed illegal, or had penal offenses. It is very likely that we've also heard in the current draft that activity that is not allowed under certain forms of regulation will be considered illegal. It's very similar that this is the channel which you consider legal, right? This is the channel through which Indians are allowed to route and transact with various blockchains. It's just that it enables them to do that in a very light touch and effortless way. In terms of support functions that will become very important in sort of working together with the wallet, one of the most important ones is the area of forensics and analytics. And here, since we hear a lot of debate around terrorism financing, around illicit activity from cryptocurrencies, it's very important to understand that a lot of this is what can be solved very well with existing tools. So what is blockchain forensics? Blockchain forensics is a new field of RegTech. It comprises tools that can monitor, trace, and manage financial crime. They use AI on top of crypto ledgers, and they use basically clustering and identification techniques to identify patterns of activity. And this is a field that is fairly advanced. So if you see in terms of what crimes it can solve as well, most of the major crimes that we take as tools of crypto forensics. So darknet markets are some of the best handled through crypto forensics, because this is completely online activity, right? And it all leaves traces. So darknet is completely online. The cryptocurrency, wherever the dark net does not leave a trace, the cryptocurrency ledger does. And there have been many cases of capture of crime in darknet markets. Ransomware, something that became very big earlier this year, also something that can be tackled quite well with blockchain forensics. These are just some quick cases, and I think we'll hear a lot more from our next speaker, who was the regulator in charge of these aspects. But scams, ransomware, hacks, these are all cases where there's been a lot of global precedent. For example, if we take the Twitter hack, I think that's something that a lot of people in the audience would also know about. There were, a lot of celebrity accounts hacked in a very short span of time. You had accounts like Barack Obama's, Elon Musk, a variety of cryptocurrency influencers, a variety of traditional influencers, even company accounts such as Apple, hacked, and there was a Bitcoin address that was put up where people were asked to donate and giveaway. It was a giveaway scam, right? And in this case, through the use of cryptofforensics, within 24 hours they were able to identify the addresses from where the money got siphoned off, and they were able to identify perpetrators by layering on other social media activity, whether it was in Discord or some alt-right groups and things like that. And they were able to identify these perpetrators and have them arrested within 16 days of the crime. And this is unheard of many times with traditional investigations, where you have to follow so much precedent. Even sharing information is so constrained. Here you have a public ledger. You just have to learn how to read it, and then it can tell you a lot about illicit activity that happens. And there's been a lot of precedent in this. Like I said, we will hear from the US, but you are seeing cases. For example, the Australian government, the Australian tax office has announced that it's investing $1 billion into the usage of forensics to track down and fine people who are not making tax filings. They actually expect a $3 billion return on doing this. There are cases where Interpol has built different working groups. It's also built out tools where they start actively monitoring at a cross-country level criminal activity using cryptocurrency. The Singapore government, for example, in the Payment Services Act, which came into effect January last year, has actually mandated that crypto businesses actively employ these forensic tools, whether it's the banks that are banking these businesses, whether it's the business itself. They are all required to do reporting around this. So this is not a very obscure field. This is something that has been taken up in a large way globally, and we'll hear more about that today. So forensics becomes a necessary support function on top of wallets, which can tackle most of the major risks that India faces. So coming quickly into how the India wallet actually does protect against these risks. So the first risk, the one that we consider intractable, is the monetary risk. And that's where the wallet really is an innovative approach. So when we look at the financial stability concern, which we defined at the start, we have now individuals who have a unique KYC wallet. So if financial stability risks are deemed acute, if you feel there's a lot of risk of too much inflows into these assets, you could potentially place a cap on the amount of investments that flow into cryptocurrency. And these caps should not be hard caps that are then placed all the time. They're something that can be managed flexibly. They can be imposed only when you feel there is an acute financial stability risk. They're also something that can be increased or decreased based on criteria that the government defines, but it should be able to effectively help you manage the outflows from rupee into assets like this. The second piece is around cross-border flows. So the India wallet, as we said, is something that that has an identity linked to it. So all wallets that have this identity linked to them are Indian wallets by definition. All wallets that don't have these identities are considered a foreign wallet. So any transfers you make to wallets that go without a sort of DigiLocker verification, these count as foreign wallets, and then you have a cross-border transaction in the making, and this is something that can actively be tagged or identified in the wallet as a cross-border transaction. And the next piece is when you're trying to manage exchange rate risk and capital controls, and you have a way to identify cross-border transactions, then if the government is keen to impose this LRS limit on how much is allowed under the liberalized remittance scheme, how much free movement of capital is allowed, then they could theoretically impose this on the wallets. These wallets can also proactively send alerts both to the citizens and the government if this prescribed annual limit is getting breached or is likely to be breached. And there should also, we believe, be a process where people should be able to have their limits increased or decreased, or have it revised based on certain guidance that the government makes around, risk appetite of investors and the kind of risk-taking ability that they have and things like that. So these are difficult challenges to control in the traditional sense, but once you bring crypto flows into a wallet and you have a channel which is recognized, there's a lot you can do in terms of managing this monetary risk. The second piece was how you can really tackle illicit activity and compliance risks. And this is where, again, as we've talked about forensics, you will have a unique deduplicated wallet, which then becomes a sort of gateway for activity into and out of India. And you have forensic tools which are able to track patterns of illicit activity, which are able to identify bad actors. And this solution is something that can work in terms of a proactive prevention. If you have already identified suspicious wallets, you can potentially block transactions to such wallets. It can also be reactive, where you're tracking for certain patterns or behavior from certain kinds of wallets which you have identified as having risky activity. It is something that can work in both a reactive and proactive way. It's also a solution that will work for all kinds of projects. So if you're looking at projects across DeFi, NFT, Web3, this is a solution which can tackle risk across these platforms. And when you're trying to handle tax and compliance risk, that is where you can have automated compliance tools made if necessary. So the India wallet already is giving you a way to track and manage your activity in crypto. You can also have easily automated taxation tools built onto it, which can sort of manage your reporting and compliance in a seamless way. I think in terms of forensics, we will look at it going forward. Yes, and how would this help with market risks and investor protection? So because the wallet has become the sort of gateway for crypto applications to integrate and work with Indian citizens, it's also a place where you can theoretically vet the kind of projects. If you make guidelines around this, you can protect against excessively scammy projects. It's also a place where you can secure the KYC process of citizens, so you can have their data secure in a way that it's not getting spread and tagged onto all kinds of blockchain activity and platforms. Also, if you have a custodial wallet, then the solution is something that provides safe custody. It provides protection against loss of keys for investors. And also, when you think from the perspective of regulation of industry actors and market manipulation, largely it's giving you a bridge, it's giving you a point at which you can have some oversight. You can, if needed, take action against actors, because at the moment there is almost no visibility that government has in the interactions that are taking place between crypto service providers and citizens. And lastly, how does this create a sort of light touch approach? How will it handle innovation? So for users, if you see, this is something where the user experience remains unchanged. People are working with crypto exactly the same way that they did traditionally. It is something that's making it easy for people to have full compliance. For innovators, it's something that's enabling accurate KYC. It's helping them handle FEMA compliances, which are very difficult right now to tackle. It also makes most of tracking and compliance easy for businesses, because all they have to do is ensure they are onboarding verified wallets instead of managing a lot of paperwork and analytics and all of this reporting themselves. From a financial institution or bank perspective, this is also a solution which can help them manage their risks in banking crypto businesses. So it helps them handle the KYC, AML compliance. It also gives them real-time insight into the Indian market, Indian activity. If some dashboards or certain data is made available to them, they can easily then manage their operational risk in banking crypto players. And from the government's perspective, this gives them one place to sort of manage all their core risks together. It gives them real-time data and insight into crypto-related activity. It also enables a more responsive and agile regulation around these assets. So we believe this is a model with many USPs. One, it does not really rely on intermediaries for reporting. Of course, the wallet can count as an intermediary, but most capabilities in the wallet are sort of pre-prescribed. It works for all kinds of crypto activity. It is a light touch model because it just requires a one-time KYC, and that's all it takes from a user and business perspective. It's something that blends in seamlessly with crypto operations, so it's not something that really creates friction in the way that projects are operating. And it's also something where all other compliances can then easily layer on, whether it's taxation or any reporting around cross-border activity. It becomes easy for everyone to manage. And we believe overall, this is an approach that will build on India's leadership in digitization. It is something that will promote innovation in new technology. It is something that builds forward on the tech stack. It is something that stop my presentation. Just take one or two questions and I will have our journalists. I'm just trying to take all right. So I don't see too many questions on this. I'm happy available to chat after this keynote as well. I think we're very keen to hear from Sigal on her incredible experience and overseeing and seeing the evolution of forensics with this technology. And I think she needs very little introduction. Sigal, we have done some announcements also around your presence. Sigal was the former Undersecretary of the US Treasury who crime is really getting tackled. Yes.
Tanvi, you cut out for a second, so I think you introduced me, but I want to make sure you can hear me now.
Yes, we can hear you now. Yes, I did introduce you, so we're very much looking forward to hearing.
Okay, terrific. Well, it's wonderful to be here. I'm truly honored to be invited to speak about a topic that I feel so passionately about. And Tanvi, I wanted to commend you for the fascinating work that you've been doing. And I'm also very much looking forward to reading and studying your recommendations. I am, as Tanvi already mentioned, I was the Undersecretary for Terrorism and Financial Intelligence at the U.S. Treasury Department, where I oversaw the U.S. sanctions program, OFAC, the U.S. anti-money laundering program, FinCEN, a policy shop that did a tremendous amount of work both with our National Security Council and also overseas as the lead for the United States in the Financial Action Task Force, and also an intelligence agency. And before that, in addition to being in the private sector, I was also had a number of high-ranking roles at the U.S. Department of Justice and the U.S. Department of Homeland Security. I am now a general partner at Rivet Capital. Rivet is a global investment firm in fintech and crypto, and we have really incredible conviction on the opportunities that India has already provided and can provide well into the future as a country that has been so forward-leaning in promoting new technology and financial services. I'm also an advisor to one of the blockchain analytic firms that you mentioned. It's called Chainalysis. It's we think of it as the premier blockchain analytic firm that works closely with governments, financial institutions, and those in crypto to do things like transaction monitoring, KYT. It's been able, among many other things, it's been able to provide really incredible insights to assist the ecosystem and help drive illicit finance out. So you might ask, what is somebody who was one of the top regulators for anti-money laundering in the US, and also who was a former prosecutor now doing in fintech and crypto or Web3? And I'm going to start my remarks just by telling you how I got to where I am today. When I was at the Treasury Department, one of the things that became increasingly clear to me, particularly as I traveled around the globe, was that banks had, in many respects, massively de-risked all over the world. And the numbers really bear that out. For example, just from a US perspective, the number of US global correspondent banks have been very much on the decline since 2012. And the other thing that was increasingly clear to me was that far too many people around the world weren't getting access to a wide variety of financial services that can really lead to economic opportunity and empowerment. In fact, as of 2017, there were an estimated 1.7 billion people in the world who were unbanked. Although actually the majority of those people do have access to a mobile phone. And I can tell you, I can't tell you how many meetings I attended both in the US and globally, where we spoke about solving the financial inclusion problem, but we really never got to that solution that's so desperately needed. And so putting those two things together, I really came to the conclusion that in certain respects, our financial system just wasn't set up to sufficiently serve enough people. And after spending a lot of time now studying the sector, I've also come to the conclusion that the only way we're going to have a chance of success in bringing more people across access to a greater variety of products, which again can lead to economic opportunity and empowerment, was if we invested in truly transformational financial technologies. And having spent the last year and a half in this sector, I believe that those transformational technologies can be found very much in fintech and in crypto. And I believe that's the case for a number of reasons, not least of which is because really some of the best engineering talent in the world today are going into crypto or in fintech. And by the way, they are so excited about the promise of this new technology that they're moving to places where they feel like they can innovate with openness and opportunity, including through clear regulatory structures. We are seeing truly incredible entrepreneurs around the world rebuilding global infrastructure on new rails that have enormous potential, not only to make the system much easier to use and more efficient, but also more secure. And this really goes far beyond just financial infrastructure. We're talking about non-fungible tokens or NFTs that allow creators greater control over their work and the ability to capture more of the economic value it generates. You talked about smart contracts that can enable automated trustless transactions between counterparties without the need for an intermediary that often takes up enormous fees and slows transactions. We're seeing new technologies that can revolutionize sectors like healthcare, other supply chains, and much more. And I also think because of the transparency of the blockchain, which you already spoke about, it also has enormous potential for things like the delivery of humanitarian aid. countering corruption, among many other things. Of course, as with any technology or mechanism of transferring value, you are always going to have people who try to take advantage of it, who try to do nefarious things. And so I would emphasize, just as with traditional financial services or cash, bad actors will try to use it to hide illicit proceeds for a wide range of activity, whether that's money laundering, terrorist financing, child exploitation, or other criminal acts. In fact, when I was at the Treasury Department as the person who was really focused every day on preventing terrorism, on deterring countries like North Korea from further developing their weapons of mass destruction program, or a wide variety of other things that often kept me up at night, I spend a lot of time with my colleagues thinking about how do we, on the one hand, keep bad actors from exploiting financial services, while on the other hand, allowing this incredible innovation to grow and thrive in exciting new ways, including expanding financial inclusion. FinCEN, which is one of the Financial Crimes Enforcement Network, or the key anti-money laundering regulator in the United States, was one of the agencies that I supervised. It actually has long regulated crypto. It's maybe the first country or one of the first countries in the world to do so. But it was very important to us, as much as we had been looking at this and regulating the sector for a while, it was very important to us that we continue to evolve in our thinking about how to keep those illicit actors from exploiting that technology. And so we engaged in a multi-pronged approach. First, I think it's very important, was very important that we had people across my part of Treasury and very much in FinCEN who truly understood the technology. And I'm proud to say, I'm a little biased, but I think we had some of the best people in the US government who lived in crypto, who were tracking it, who were tracing it, right? Because you can't truly understand it unless you're operating it, unless you're experimenting in it. And one of the things that we learned, and that I learned specifically, and that I now see every day in the work that we do with chain analysis, is that in many ways, detecting and disrupting illicit activity in crypto is far easier than doing so, certainly in cash, but also often in traditional banking. And that's because most transactions happen on this transparent and immutable ledger. So you can often see just about in real time what is happening, as opposed to getting information retroactively. In fact, there are a lot of prosecutors in the United States who would tell you that if a bad actor is going to do bad things, they would prefer that it happen in crypto because it can be much easier to trace the activity and ultimately to arrest and disrupt the criminals. In fact, that should be a real stark warning to criminals about trying to use crypto to do bad things. You mentioned, for example, the Twitter hack, where because the hackers chose to expose their Bitcoin address at the time of the hack, thinking that they would be able to collect a lot of money in the process of doing that, law enforcement using these blockchain analytic tools was very, very quickly able to arrest the actors who were responsible. So because we had an understanding of crypto, we were able to use that understanding to provide clarity in the ecosystem. And I think that's extremely important. As an example, in a guidance document we released in 2019 around, we provided a lot of clarity to industry about what kinds of models fit within the requirements of our Bank Secrecy Act and what didn't. The other thing that we did to great effect was to provide the private sector with a lot of information about the typologies that are associated with illicit activity, so that they could use that information to keep those kinds of typologies out of their ecosystem. The other thing that we did, or second, and this is something we'd done for some time, was before I got there, was that we required crypto exchanges and administrators to follow much of the same rules as other money transmitters, right? They had to have compliance programs. They had to file suspicious activity reports. They had to keep KYC. And we also examined the exchanges, just as we examined money services businesses. This this approach, I believe, proved to be very effective and valuable, because when you're trying to trace illicit activity, it's far easier to identify the bad actors if you can trace the activity back to an exchange that holds KYC, that responds to subpoenas, that's filing SARs, that's doing transaction monitoring, among other things. That's part of why, again, I believe it's so important to have this reasonable regulation with industry, because you will find at the end of the day that if you do so, they can really be your partners in driving illicit activity out so that the extraordinary innovation can grow. And at the end of the day, of course, if it's not regulated, the activity is still going to happen. The bad actors who are committing real crimes will continue to exploit it to do bad things, but it will be far, far more difficult to actually trace the bad activity and ultimately arrest and prosecute the criminals. It's important to realize, right, that in many ways, criminals are actually technology agnostic. There's this notion that I think a lot of headlines that suggest that, you know, crypto is enabling bad illicit activity. That's not the case, in my opinion. The illicit activity is happening, and the question, regardless, and it's happened for centuries, regardless of whether or not there has been crypto. The question is, are you going to set up a reasonable regulatory scheme that helps you identify that illicit activity and drive it out so that any particular technology isn't being used in an exploitive way? And, you know, I think what we're seeing in the United States, for example, and really globally, as more governments are regulating crypto and doing in the fashion that I described, is that the amount of illicit activity has gone down massively. In fact, by some estimates, it's under 0.5% today. Alongside that, and Tanvi, I thought you did a terrific job highlighting the importance of this, we also invested in the blockchain analytic tools that allowed us to have tremendous insight into what was happening in crypto. That's an incredibly important part of building out a sophisticated regulatory system. I'll just give you one quick example, and you already gave some before, but when I was at the Treasury Department, we went after nefarious actors who were involved in ransomware attacks that were holding hospitals hostage. And as part of the action, we published and sanctioned IP addresses associated with crypto that was used in that attack. Literally within a day of our publishing that information, the blockchain analytic firms published an extensive report, not only about that address, but also linking a whole variety of others that were associated with that address. That enabled financial institutions, crypto exchanges, others in the industry to understand where there could be potential nefarious and suspicious activity, and where it was appropriate to block those from entering or being used by their system. And I remember seeing that report again within a day of our action, and I was handed it by my senior advisor, and I was just extraordinarily excited. I said, yes, this is exactly the kind of thing that we really want industry to do, whether it's in crypto or financial institutions or the like. And I saw it in this very unique way through crypto that I was just extremely excited about. Third, when I was at Treasury, I believe that it was extraordinarily important for regulators around the world to likewise have AML controls that applied to crypto. So when I started at Treasury, there were only 2 other countries that I knew of in the world that were doing this. So in addition to the US, Japan and Australia also had anti-money laundering crypto regulations. And I believe that it was really important to close that gap, because ultimately bad actors will just go to places where there's no regulation, right? Where they believe that they can operate nefariously and nobody's going to catch them. And so we set out really to encourage a number of governments really all over the world to regulate it in a similar fashion to how we were regulating it. We also had an opportunity to do that through the Financial Action Task Force or FATF, because for one of the years that I was at Treasury, we held the presidency of FATF. And in that year, we made one of our top 3 priorities really to focus on building out standards that would encourage other countries to have the right kind of regulatory regimes. And a couple of years later, I believe that regulators around the world are seeing the great value both in having oversight over the sector through regulation, while also now really taking advantage of the enormous economic opportunities that comes when the sector expands in their countries. India, of course, in particular, has always been both an exporter and an importer of great technology, as well as an incredible source of great engineering talent. If regulated smartly, the potential here, I think, is really enormous. This is an area where any country that becomes the center of innovation and an exporter of the technology, as opposed to just an importer, will see tremendous benefits over the next 10 years and beyond. And of course, there's just incredible engineering talent here. And so the opportunities, I think, will be endless. Fourth, I also think it's incredibly important to make sure that this ecosystem can continue to evolve and reach its full potential. One of the incredible things about crypto or Web3 in particular is that you also have entrepreneurs who care deeply about compliance regulation. They don't want their ecosystems, right, to be taken advantage of by bad actors just as much as regulators don't. And so they are working on incredible new compliance solutions that actually, I believe, in the long run, can be more effective than the tools that we've used in the past, even in traditional finance. This includes things like crypto native programmatic compliance tools that can be embedded in blockchains and wallets. And that I can tell you from personal experience with these companies that are being developed in really exciting ways today. Including in ways that are privacy protecting, which I think is also important, as long as you can also, again, detect and disrupt the illicit activity. And it's what I find to be incredibly exciting, by the way, and I should mention it, is that it's being developed not only for centralized exchanges, but also for decentralized finance, where likewise, I think there's real opportunity for economic innovation and growth. And of course, we have those blockchain analytic tools that I've already mentioned that are really have been doing groundbreaking work, including things like breaking up child exploitation rings, freezing terrorist assets, detecting and deterring ransomware, going after, again, that underlying criminal activity that's going to happen regardless of the financial technology that you have. The question is this a technology that can really help you go after the bad actors if you have a sophisticated regulatory regime? And I believe the answer very much is yes. And again, I believe that because it really have some of the smartest engineers in the world that are working on those problems. In order for all of this to develop, it's also really critical that overburdensome regulation or antiquated regulation doesn't strangle this innovation before it can reach its maturity. That means a really thoughtful approach to regulation. I used to say, when I was at Treasury, that we were still operating under the Bank Secrecy Act, a statute which was passed in the 70s when we were still using the rotary phone. And we really had to take a very serious look at whether or not those rules were the most effective rules in accomplishing what we wanted to accomplish. Right? That means we have to understand that some of those frameworks were developed decades ago, and they may not be the exact right frameworks for today. I have to say, I was very excited to read that the Indian government just spent time this week engaging with industry and learning about the opportunities, right? In my experience, when you work together with industry, the potential is really unlimited, whether that's through information sharing, having real sandboxes or pilots, or incentivizing the development of better compliance tools, just as the other innovation is growing to sit alongside Web3 or crypto. We have found that approach results in really driving illicit activity radically down. As I already mentioned, illicit activity in crypto is at just by some estimates is even under 0.5%. And I think it's a number I suspect is the same as or less than what we actually have in traditional finance. And I believe that that number, the percentage of illicit activity, has gone down significantly over the past few years because of the approach that I told you, and also because we have crypto exchanges that have actually built out really important compliance programs that are constantly improving and that are working regularly with law enforcement to stop bad activity. The opposite approach, an all-out ban, are, in my opinion, not the answer, as they merely push bad activity under the rug, driving it into black markets where regulators have a much less ability to influence, right? And it also makes it much more difficult to get at some of the things that you were talking about before, reporting on illicit activity, collecting taxes, among other things. I wanted to end just with this final note. Regulators are so often focused on preventing risks. And this is important. As a former regulator and prosecutor, I have a deep understanding of risk. It kept me awake for many, many long nights. But it is just as important to focus on opportunity and to consider regulation from the perspective of what it can enable rather than just what it will prevent. India has already been a global leader in building financial infrastructure with Aadhaar and UPI. And in crypto, India has this amazing opportunity to be a part of this new transformation as entrepreneurs are building the new financial infrastructure for the world. I went from a position where I got to spend my time with some of the best public servants in the world. And now I get to spend my time with some of the greatest engineering talent and entrepreneurs who are reimagining what the world can look like, who are solving those problems that I saw around the globe when I was at the Treasury Department. From this vantage point, having now been on both sides, which I find I'm incredibly excited to have been able to have that opportunity, I am incredibly optimistic for the future and look forward really with great excitement about how India will be involved, both by providing regulatory frameworks that this ecosystem needs to grow and by being at the forefront of this transformational innovation. So thank you again, Tanvi, for inviting me. It's been terrific to be here with you.
Thank you, Sigal. I think that was a wonderful address, and I think there's a lot to take away from everybody who's been watching this. I think people don't know just to what extent this is a system very capable of pushing back on bad activity. And I think there's a lot of people who believe in pushing back bad activity. I mean, even people in the industry are not opposed to this, as is commonly understood. So I think it was amazing to have you, Sigal. Thank you so much for your time. And hopefully we'll see more of you in India.
I look forward to coming back very, very soon. Thank you so much, Tanvi.
Thank you. All right, so we heard just now, and we're speaking just in time with Mr. Modi's remark of having democracies come together to tackle risk from crypto activity. We've just been speaking about an India model. We are the largest democracy. We just heard from a former top US regulator overseeing criminal activity with crypto on just how easy it is to tackle these crimes. And we now hear from another democracy that's a big strategic partner of India's as well, which is Japan. Japan has also been a pioneer in this realm of cryptocurrency regulation. If you recall, the Mt. Gox hack, which is very famous, is one of the markers in the crypto regulatory timeline, occurred in Japan, was tackled by the FSA, the very agency that we are going to hear from now. So it's an honor to have Mr. Yuta Takanashi. He is director at the FSA. He has been very closely involved in Japan's efforts and also its global cooperation in dealing with crypto crime. And I think over to you, sir. I would not like to take any time away from you. And we would love to hear what has been Japan's overall strategy when it comes to dealing with cryptocurrencies, and how have you tackled exchange regulation and a whole host of other challenges.
Okay, thank you, Tembi, for your kind introduction. It's a great honor to participate in this great event. And before I jump into my presentation, I congratulate you and Policy 4.0 for the first anniversary. And I'd like to share my presentation. Can you hear?
Yes, we
can you see it?
Yes.
Okay. Okay, so my name is Yuta Takanashi, Director for International Digital Strategy and Policy at Financial Services Agency, Japan. I have worked for this CRISP space since 2017 and have been representing JFSA, Japanese financial regulator, at various working groups on financial innovation, including crypto assets and stablecoin in the FSB, Financial Stability Board, and other international fora. So I would like to share what Japan has done in CRISP space through rounds of regulatory reforms. This is overview of the regulatory reforms in Japan. Japan, I think, is the first country to introduce CRISP regulation among other major countries. And in 2015, JFSA introduced new regulatory framework on cryptocurrency in response to Mt. Gox's incident, as Tambi mentioned, and also the guidance on ML-CFT issued by FATF, the international group of regulators developing ML-CFT standards. After the introduction of the regulation, Japanese crypto market grew larger and larger. However, one of the largest exchange called CoinCheck was hacked in 2018. And in response, JFSA completed a second round of regulatory reform in 2019. And now we are working on the third round of regulatory reforms, given the rise of stablecoin and decentralized finance called DeFi, gazing at the international regulatory discussion as well. So I will try to give a little more details on each of the regulatory reforms. As explained, in 2014, one of the largest crypto exchange at that time, called Mt. Gox, was hacked and filed bankruptcy in Japan. It was a very shocking incident, not just for Japan, but also the world, as this is the world's first big hacking incident in this space. And at the same time, the FATF issued new guidance on ML-CFT regulation, focusing on virtual asset in 2015. We at the JFSA, we saw that this event is very important for the future of crypto asset and crypto space. So this development led us to the first round of regulatory reforms, in which we amended Payment Service Act. And interesting thing is this is a Payment Service Act. So at that time, we thought that cryptocurrency is actually as a means of payment. So that's why we regulate the cryptocurrency as under the Payment Service Act. And also we amended ML-CFT regulation to cover the crypto asset in 2016. Through these amendments, we defined cryptocurrency in a regulatory system and require crypto exchanges to register to us. I think it was a very unique idea to actually define the cryptocurrency in a regulatory regime. Many other countries decided to apply the same regulation as like the securities regulation or commodity regulation or e-money regulation in the cryptocurrency. But we actually defined cryptocurrency separately from other like financial assets. And then we required crypto exchanges to conduct proper know your customer KYC and customer due diligence CDD in conjunction with other additional requirements such as minimum capital requirements, minimum sets of information to explain for users, and separation of customer assets from corporate assets, and also the cybersecurity measures. And also, this is unique, and given the nature of the technical nature of this industry, we have also decided to delegate part of our regulatory and supervisory power to self-regulatory organization, SRO. However, after this 2016 regulatory reforms, several crypto market developments greatly affected our views on the industry. The biggest one was coin check hacking incident. So it is the second wave of hacking incident. And in that incident, customers lost more than $500 million, and which was the largest hacking incident at that time. And this dramatically changed the risk awareness of the investors and general public, as well as regulator. And this incident also casts light on the excessive risk-taking of individual investors through speculative activities and the operational immaturity of crypto asset exchanges. Though these the business size and business breadth of business expanded very rapidly and very dramatically. Alongside, outside of Japan, especially, concern on the scam using ICO, initial coin offering scheme, had grown large within the regulatory community. Actually, IOSCO, the international regulatory body focusing on market regulation, issued warning to investors and businesses conducting ICO. Taking these new developments, JFSA established a study group on crypto exchanges, which submitted regulatory reform proposal to JFSA in 2018. On the crypto exchanges, we took several measures to improve operation of the exchanges. First, we require exchanges to keep customer crypto assets in the cold wallet. It is meaning the offline wallet. In the exceptional cases, exchanges can manage them in the hot wallet, the online wallet, but they need to set aside the same amount of the same token in secure ways. I think this is very strict rule, because if the customer asset is sit in the cold wallet, it is not so usable for crypto exchanges or even users. So this is very strict rule, but because the coin check hacking was targeted, the attacker targets the hot wallet. So that's why we decided to impose this restriction. And second, we imposed restriction on the advertisement and the solicitation of crypto exchanges in order not to mislead users or customers, or not induce individual investors to take excessive risks. And at that time, we saw lots of TV advertisement and very kind of the exaggerating the opportunity side and not that much about risks they could face. So we decided to impose restriction on this type of advertisement and solicitations. And third, following FATF recommendations in 2018, we newly regulate custody service providers, not just crypto exchanges, and require these custody service providers KYC and CDD, as well as user protection measures in a similar manner as crypto exchanges. So this is also very important regulation, I think. As we also concern risks associated with so-called anonymity enhanced coins, as the previous speaker discussed, and those with features that cause problems in meeting regulatory requirements, we decided to require prior filing when crypto exchanges plan to list new coins. In practice, self-regulatory organization checks technical aspect as well as other aspects in accordance with their self-regulation before exchanges file their plan to JFSA regulator. And I think this is also unique regulation as compared to other jurisdictions. We basically, in cooperation with self-regulatory organization, we check whether this new coins that exchange plan to list is have no problem. or just okay to list. So this is very, I think, unique. We also introduced similar regulation as other securities focusing on market misconduct, such as dissemination of rumors and the price manipulation, because at that time, there were lots of cases where influential investors or even famous celebrities intentionally or sometimes unintentionally affect other investors' behavior through such as posts on the social network. So that is also the problem, because seeing this post, the ordinary investors can follow the very influential individuals, and this cause problem for their investment decision making. And before the regulatory reforms, most of the trading in Japan was on the margin, which could greatly amplify risks investors could suffer. In some cases, investors trade coins with near 25 times of leverage, and we saw lots of cases of bankruptcy of investors. So to limit this excessive risk taking, we put limitation on the leverage ratio up to 2 times in a similar manner as FX trading. I understand individual investors in Japan sometimes criticize this regulation because they cannot take much risks, and this will limit the opportunity side as well. But we thought that this is very important to limit the risks the individual investors can take, because of the big volatility and difficulty to understand actual risks associated with investing or speculative activities. And as for ICO, the initial coin offering, we clarified that some ICO projects are within the limit of securities regulation and introduced new set of regulatory treatment on security token offering in order to clarify in what conditions security tokens are issued and traded. This clarification has actually encouraged large traditional financial institutions as well as new venture type of institutions to enter this space as a new opportunity for them to improve securities market businesses. Again, after the 2019 regulatory reforms, we saw lots of new developments in the crypto space. I think this is amazing and amazingly rapid, and in some cases it's kind of profound. Such development includes proposal of Libra, now called DM, proposed by Facebook and related parties. And this is a potential case of global stablecoin, which could drastically change the landscape of payment system. And I think this was a kind of like the ringing alarm clock for us regulators. And we G20 members realized the need for improvements of our current cross-border payment system. And now G20 takes initiative and project to improve our cross-border payment system. In this project, we also think how we can take advantage of new innovation such as stablecoin or CBDC, but at the same time, we also need to think about risks associated with these new developments. And more recently, even in these humans, we saw very rapid and drastic developments of decentralized finance called DeFi. In terms of daily trading volume, some large decentralized exchanges exceed world's largest centralized exchanges. And this is, I think this is unimaginable just a few months ago. And for us regulators, this makes it even more difficult to achieve our regulatory goals, as it is highly difficult to regulate decentralized finance because they are in principle just program, and which could cause problems to apply current regulatory requirements focusing on intermediaries such as banks. Of course, most of the decentralized finance or DeFi project is not actually completely decentralized, and in many cases, there are centralized parties actually manage the project, but if all the component and is decentralized, it becomes much more difficult for us to regulate. So we need to think about how we can deal with these developments. And another concern is regarding ransomware attack. As the previous speaker mentioned, we have lots of ransomware attacks, especially after the COVID-19. Criminals often require ransom payment in crypto assets like Bitcoin, and many critical infrastructures, hospitals, and businesses are targeted. And actually, some of them actually pay the ransom in crypto assets. And in some cases, difficult to retrieve these crypto assets. So concerning this new development, JFSA has just established new study group on digital and decentralized finance, aiming at developing proposal on another round of regulatory reforms. The study group has just published an interim report a few days ago. Unfortunately, it's just in the Japanese language only. So I hope my colleagues translate it into English or other language. But in the report, they are considering to propose to apply same business, same risk, same regulation principles, as well as technology neutral approach, and require high standards for stablecoin and other crypto assets that aims at becoming widely available payment services, like other payment services, e-money or other type of payment service providers. In order to meet such standards, developers or service providers may need to choose appropriate technical design, including, for example, those prohibit transactions between accounts without KYC or customer due diligence. And for more decentralized system, the study group thinks that enhancing dialogue among regulators and other stakeholders, including developers, are very important to foster mutual understanding on what are the standards they are required and the ways to meet them, such as technical design that helps foster compliance. And this is still interim report, and international discussion on this topic are still going. So there will continue discussion going forward, but we hope that they complete their work. The study group completes their work with set of policy proposals in the near future. And in this regard, I think dialogue is important, and Policy 4.0 provides great opportunity for us regulators and other stakeholders to deep understanding through dialogue. And I'm very happy to take part in several sessions myself. And I hope for the flourish of this meaningful activity going forward. And I will stop here. And if anyone have any comments or questions, I'm very happy to answer. Thank you.
Yes, thank you so much, sir. I think that was a very enlightening proposal. I think India is actually going through many of these same questions that you've highlighted in terms of soliciting ads. Like, this is a big discussion here. So how have you seen the effectiveness of the approach since you came out with the regulations?
Yeah, as for the exchanges, I think many of the exchanges improve the operational maturity, and also because of coin check hacking, and after the discussion after the coin check hacking, general public become more aware of the risks associated with this new industry, and advertisement and solicitation becomes much more compliant with our regulation. So I think this is very effective, but at the same time, I guess this strict regulation on crypto exchanges could have some effects that the decentralized finance or development of the new system outside of the regulated world, if the crypto exchanges are heavily regulated, businesses and entrepreneurs to decide, invest their time and efforts in more decentralized system, and investors may choose to use the decentralized exchanges or decentralized services because of the strict regulation on the centralized part. So I think the regulation has pros and cons always. So we need to understand what our regulatory regime caused in these few years, and also how we can manage the risks associated with new developments, such as decentralized finance. So we usually become the self-complacent that our regulation is working well, but of course we need to review and come back to understand the influence and also the implication for current development of our regulation.
Okay, so and with in dealing with self-regulatory organizations, what has been the benefit of having the SRO in Japan, and how has it worked in your experience?
Yeah, I think self-regulatory organization helps us to understand technical aspects, especially because, of course, the regulators don't have enough capacity on the technical aspect or technical capability, and self-regulatory organization especially focus on technical aspects as well as very detailed requirements with the help from the industry participants, especially those who have technical knowledge. So this helps us to separate kind of the burden, more like legal and regulatory aspect on GFSAS, and the more technical and more detailed aspect on the self-regulatory organization. So I think this helps us to effectively manage the risks associated with this industry. Of course, because this industry is still very young and very early stage, so self-regulatory organization also needs to improve their capacity, and also they need to have more human resources actually. So not just industry, but also the self-regulatory organization, still they are struggling to overcome all the difficulties. But in general, I think having a self-regulatory organization helps us to manage risks effectively and more in more say proper manner kind of thing. So we don't need to intervene too much on the technical aspect.
All right, so and about the learning cycle, it takes for regulators to really get a handle on these issues. I mean, Japan was one of the first countries, and I think responded quite much faster than other countries to these issues. So how did you build that capacity internally in the FSA on tackling these issues? Yeah,
I think the part of the reason why we can take the fast approach is that actually 25% of our colleagues come from outside of the government, and some of them engineers, some of them come from the financial industry, and having some experience in managing the system. So this is very important aspect in terms of the capacity. And also we send some people to the university and learn from academia. So I myself went to Georgetown University for 1 year to conduct research on the blockchain and the regulation under the professors from business school and computer science. So this helps us to not just myself, but also the GFSA as an organization learned lots about crypto space and regulatory issues. So these efforts helps us to understand the risks associated with this industry as well as the opportunity associated with this new innovation. So I think the human resource capacity building is very important, and also I think this is a good aspect, but aspect is because of the Mt. Gox hacking. This actually created lots of like questions, not just industry, but also among like political space, that whether we can just ignore this industry and keep them unregulated. So this kind of the social pressure drives us to pay more attention on this industry, and that like encourage us to like decide to like take more like aggressive approach to actually regulate and define the cryptocurrency and regulate this industry, focusing on crypto exchanges.
And how long did it take the FSA to respond?
Yeah, I think the first incident Mt. Gox hack was 2014, and our regulatory reform completed in 2016. So I think it takes 2 years. And usually within GFSA, we establish study group or working group, inviting outside stakeholders like academia or businesses, engineers, or consumers, and ask them to discuss how we can approach this issue. And it takes 1 year or 1 year and a half. And then we collect the feedback from industry and decide to like actually like reform, amend our regulation or amend our legal system. It takes around half a year or sometimes 1 year, and also discuss with the political space, political like parties. So usually it takes 1 year, sorry, the 2 year and the 2 year half. So in this case, it takes I think around 2 years, and the second round of reform also takes I think 2 years. And currently we have just established a study group, and they just published the interim report. And I think it takes some more time, but I think our third round regulatory reforms is becoming closer and closer, I think.
That's great. Well, thank you so much, sir, for your time. And I think your inputs were very relevant to the debates here. And I'm sure everyone has learned a lot. So thank you.
Yeah, thank you. Thank you very much, Tanvi.
All right. So thank you, everyone, for staying with us through the session. This brings us to the end of our event. And I'm sure you've all taken away a lot from these discussions. I hope it has thrown light on a lot of regulatory policy issues around cryptocurrency. You've heard from Indian policy leaders. You've heard our proposal of a solution as well for India. You've also heard from two of the largest democracies in the world in terms of how they've approached the whole process and what kinds of regulations they've put in place. So thank you for your time, and we hope to see you at future events with Policy Bureau. Thank you.